A 1031 exchange, also called a tax-deferred exchange, is one of the most powerful tax-deferred strategies remaining available for taxpayers. This provision is found in Section 1031 of the Internal Revenue Code. The rationale behind it is this: taxpayers should never have to pay income taxes on the sale of property if they intend to reinvest the proceeds in a similar or like-kind property. Now, the term like-kind can be misleading. A like-kind exchange does not mean you take the deed from your duplex and find someone else with a similar duplex and you trade or swap deeds. No, it's more like taking an item out of your investment portfolio and replacing it with another item within that portfolio. So what do you mean by the term like-kind? Like-kind refers to the reason that you own the property that you are replacing. To qualify, the property must be held for business or investment. If it does, then the replacement property must be a continuation of how that property is being held. So for example, if the property being relinquished is a condo being held for rent, well, that's an investment. It could therefore be replaced with any type of investment or business property, including undeveloped land, a strip mall, rental housing, a warehouse, or any combination thereof. As long as the reason for owning the relinquished property and the replacement property match, then it's considered like-kind, regardless of the type of property involved. Now, the term exchange is also misleading in the sense that it suggests that there must be a simultaneous transaction. Though this is possible, it's hardly ever the case. A provision in the code allows up to 45 days after the closing of the sale on your relinquished property to identify a replacement property and up to 180 days to close. Now let's talk about the advantages. With a properly orchestrated 1031 exchange, you can sell your property held for business or investment for a gain and defer both the federal and state income tax liability by replacing it with a like-kind property. This allows you to keep 100% of your proceeds working for you when you reinvest in a replacement property. So what's the big deal? The big deal is that this is a powerful wealth building tool because you can continue exchanging properties as a lifelong strategy, always deferring the payment of your income tax liability and keeping your equity working for you. Now, using this strategy, the value of your real estate portfolio and consequently your net worth will grow exponentially faster over your lifetime as you continually defer the payment of your income tax liabilities. Now here's the beauty. After your death, your heirs will inherit your property and receive a step up in the cost basis equal to the fair market value of the property at the time of your death. This basically means that all the deferred gains get zeroed out and your heirs can, if they choose, immediately sell the property without incurring any capital gains and/or depreciation recapture income taxes at all. So you're probably thinking, now, well, that's great for my heirs, but what's in it for me while I'm still here? Well, first of all, this process does not mean that you can't ever take any cash. It simply means that the cash you decide to take becomes taxable and the cash you don't take continues to be deferred. But not only that, when you exchange an income property and transfer the equity to a higher value income property, don't you think it's likely that both the value and the income on the larger or higher value property will increase at a faster pace? For example, if you cleared, say, $250,000 on the sale of a rental condo valued at $300,000 and you purchased an $800,000 fourplex, all things being equal, a 5% appreciation on $300,000 is $15,000, and 5% appreciation on $800,000 is $40,000. And that's compounded each year. So which do you suppose builds wealth faster? Obviously, the larger one. Not to mention that after putting $250,000 down, your net disposable cash flow would likely be higher on the 4 apartment units, even though it has a higher mortgage than that of a single condo unit. Now that's what wealth building looks like. Now, a basic rule of thumb on an exchange is to always replace a property with one of equal or higher value than the one that's being relinquished. Never trade down. Trading down always results in boot received. Boot is either cash, debt reduction, or both. This will trigger a tax liability. Now, there are other rules, considerations, and procedures that go beyond the purpose of this video. And if you want more information, contact me. We can go deeper into this. But my purpose here is to show you how wealth is created through this very powerful vehicle. So here's the bottom line. Looking at a 1031 exchange like this, the deferred taxes is money that, were it not for an exchange, would have gone to the IRS as capital gains taxes. But instead, you get to keep those funds and invest interest-free and payment-free into an investment property. This free loan can easily reach levels not only in the hundreds of thousands of dollars, but even in the millions. Now let's take a look at a practical example. Imagine that you sell an investment property such as a duplex and you make a profit of, say, $200,000. Now you will incur a capital gains tax liability of at least $40,000, which you will send to the IRS. Now base that on the highest capital gains tax rate of 20%. So 20% of $200,000 is $40,000. But with an exchange, you defer payment of those capital gains by repurchasing a replacement property and exchanging it in a 1031 like-kind exchange. In other words, you use the entire net proceeds to buy another investment property of equal or greater value. That means you don't have to pay the $40,000 in capital gains to the IRS. You keep the entire $200,000 profit and apply it to the replacement property, and it remains there until you sell the replacement property. And when you do sell, you can delay the tax liability again by doing yet another 1031 exchange. Now let's go back to our example. We've established that you walk away from the closing table with $200,000 net sales proceeds. We've also established that the $200,000 is really $160,000 plus the $40,000 that you should have paid to the government in taxes. But through the 1031 exchange, you get to reinvest it instead. Now, you could have used the entire $200,000 as a 20% down payment on a single $1 million property. But for illustrative purposes, we're going to break it into two separate investments just so that you can see what can be done with the money that you weren't supposed to get. Okay? So we will invest the $160,000 as a 20% down payment on an $800,000 property, and we will use the remaining $40,000 as a 20% down payment on a $200,000 property. Now take notice of what you just did. You essentially took a $40,000 free government loan and purchased a $200,000 property. That's 5 times the amount of your investment. Now, the bigger point is this. A $200,000 property that you would not have otherwise had access to had you not deferred the capital gains taxes through a 1031 exchange. That's what you essentially did. That money would be forever gone to the IRS. Now let's just take a look at the result of that $40,000 investment if you held onto it for 10 years. Assuming that this $200,000 investment will purchase an income property that will cash flow and cover all of your expenses, including principal, interest, taxes, and insurance. Now let's also assume that a conservative 6% annual appreciation in value over a 10-year period. Now, based on that scenario, the property would increase in value from $200,000 to $358,170. With an interest rate of 4.5% over 30 years on that $160,000 loan, the balance would reduce to a little over $128,143. So if you subtract the difference, the current balance from the appreciated value, you will find that your $40,000 down payment, which should have gone to the government in taxes, has grown to over $230,000 in equity. That's an increase of 575% over 10 years. Now, if you decide to cash out at this point and not reinvest and just pay the taxes and depreciation recapture, when it's all said and done, and I won't do the math here, but you will clear just over $182,000 after taxes. Now imagine if you decide to sell the property and instead of cashing out and defer taxes by engaging in yet another 1031 exchange. You would gain your capital gains basis, and your depreciation would go into the new replacement property. But you would have approximately $230,000 to use as a down payment. Using this as a 20% down payment, you would be able to purchase a property in the price range of $1,150,000. Now imagine the possibilities. You could purchase maybe a couple of triplexes or even a small strip mall. It's all up to you. The point is that $40,000 that you held back from the IRS has now become nearly $1.2 million worth of income property. That's an increase of nearly 30 times in just 10 years. Now I'm about to blow you away, because remember, we separated that original $200,000 gain into two investments. We've only looked at the smaller portion to show you what could happen with the portion that should have gone in taxes to the IRS had you just cashed out. But we haven't even looked at the other $160,000 portion. Now, I won't do all the math and the calculations, but based on the same scenario of appreciation and reinvesting that portion over 10 years, you would be able to purchase a property of over $4.1 million. Now, adding these two parts, the 4.1 and the 1.2, after over 10 years, you will be holding title to over $5.3 million in income property. Now, this is not pie in the sky. This happens all the time, every day. This is the space where the serious real estate investor operate, and so can you.